Forming Perspective. In this series, we have broken down our Forming Perspective webinar into topic-based videos, allowing you, the viewer, to decide which topics you want to learn more about.
We've entered a bear market, defined as the market from a high to a current low drops more than 20%. You're going to see a bunch of grizzly bears really looking mean on financial magazines to try and make sure that the media can cause fear and anxiety and try and scare some more people out of the market. But bear markets are very common. In fact, they happen about once every 5 years. And this slide kind of lays out the history of them. And what I want you to see in this slide is that here we are, we've dropped about 24% top to bottom in the first 5 months of 2022. And what I want you to see in this slide is that the downswings, these bear markets, are both shorter in time frame, shorter in duration, and not as severe as the upswings. And we'd like to say that I'm not worried about a 20% decline or a 30% decline. I'm worried about the next 100% advance. And where we were worried about COVID, and in 30 days, the market sold off 34%. The market rallied about 100% here before we had this pullback. Or go back into the financial crisis, you've had a pullback and then you had a huge rally. And this advance that we don't want you to miss by panicking out of your investments looks like this. The client that panicked out of the financial crisis, waiting to get back in, hoping the market would go back down to that level, misses often in advance. And so where market downturns, at least historically, this may be the first time ever that the markets never recover. But from a historical standpoint, these market downturns feel permanent, but they're temporary. And if you react to them and take a temporary downturn and get out, unless you get back in below where you got out, you actually lose money. Same emotions that cause you to panic out of your investments are the same, are then justified when the market goes down. So it keeps you out. And the psychology shows that those emotions don't change back until the market goes back above where you got out, which means you took a temporary downturn and made it a permanent loss. And the loss is at whatever point you finally decide to get back in. And history shows you better get back in pretty quick, because here we have an example going back to COVID where we had extreme down days, in some cases down 10% in a day, followed by extreme upswings. What history shows on a 20-year time horizon is if you just miss 10 days of 20 years, so you miss 10 days out of thousands, you actually cut your return in half. And so you can't panic out of these investments. And the way you do that is don't have everything in these investments and make sure you have cash cushions, have a plan. But bear markets are normal. Let's not overreact to them. And let's talk a little bit about why. So this actually happens to be the worst first half. It's a new headline that's out there in financial media going back for several decades. And so we're finishing the first half down about 20%. And we don't know what the second half looks like. What we do know from a historical standpoint is it's a mixed bag. Again, there were previous years where the first half was followed by another downswing. But what I see in this slide is the higher the downswing, the more likely there was recovery in the second half. And so we'll see what happens in the second half of this year. There's a lot that's going to play out, especially what we know for certain is there's going to be a result of midterm elections, and that should basically create what is currently an uncertainty into a certainty, and the markets like those things. But historically speaking, again, from a quarterly standpoint, here is an example of bad quarters. And again, here we had a bad quarter in 2022 for the second quarter. Don't know what the next year is going to look like, but bad quarters have often been followed by good years, with the one exception of the tech bubble, which had another downswing there after 9/11 happened and then recovered from there. But if you take a time horizon, which we're not investing clients' portfolios for any one quarter, half year, full year, it's a lifetime portfolio. If you change your perspective and give yourself time, it's amazing what happens when you play out a 3-year time horizon, a 5-year time horizon, a 10-year time horizon. But this is what we're talking about. We're talking about long-term investing. It means you can't in any one day, week, quarter, month overreact to something. You can't think in terms of all or nothing. And yet you might say, but what about recessions? That's got to be different. Well, not really. The COVID recession lasted only a few months. And historically speaking, most recessions last less than about a year. The only exception was the Great Depression. And quite frankly, back then, there wasn't technology to get people out of their investments as there is today. There were rules back then that you could make $1,000 investment and only have to put $100 down. Well, if that investment dropped $200 or dropped 20%, if that investment went into a bear market, you lost your $100 and then you owed the bank $100. And then because back then there wasn't FDIC insurance, the banks just shut their doors and 4,000 plus banks went under. And so we've learned a lot of lessons from that would prevent that from happening again. And that's what humanity does. We learn lessons, put rules in place to try and prevent those things from happening again. But what I want to show you is that this recession, if it happens, is going to be inflation driven, and they tend not to be huge recessions, at least historically. But let's look at what recessions look like as far as the market. 6 months before recessions hit, this is a representation of returns, and they're all over the place because recessions happen for different reasons. During the recession, same thing. You have returns all over the place. But again, what I want you to see is go out 1 year, or more importantly, go out 3 or 5 years out. Again, a recession is a wonderful opportunity for a purification of our economy, to get rid of excess, to allow us to learn some lessons, and more importantly, to allow new investors the opportunity to step into these markets and allow those of us that are no longer adding to our investments to just hold on and ride out the markets, knowing that by rebalancing portfolios like we do, in recessions or in these downturns, we may take dividends or interest and buy some of these things that are down. We may rebalance, which is by definition selling what has done well, what is high, and buying some of what is not doing so well. But we're going to take care of that. What I don't want you to do is make an all or nothing decision.